Right.
All right. So loan fundamentals. So the goal of today's class, really, you guys, is super basic information. Like, we're not here to have you guys start doing loans. I don't want you out in the field at open houses blurting a ton of stuff regarding financing. That's our job. And we're going to teach you guys how to push people our way, okay? But I want you guys to have basic knowledge. Like, what are the basic loans out there? And we all know this stuff. A lot of this might just be repeat for most of you, to be honest with you. But I think it's good to go over these and just have a refresher. There's a video here, take pictures of slides. But in reality, like, we want you to call us. If you really have a question on something, give us a call, okay? So basic fundamentals. So we're gonna talk about loan programs, common buyer financing questions. That's a big one, because what are the most common question we get from buyers all the time? How much can I qualify for? What are the rates? So, yep. How to identify opportunities and when to bring in your lender, which anytime you start getting into that financing, that's when you need to reach out to Jesse or myself or get your trusted lender on the phone, because again, you don't want to put yourself in a position where you say something incorrectly and now you've jeopardized a potential transaction for yourself. Okay, that's
Or worse, your license.
or worse, your license. All right. So
That's right.
I'm a big believer.
That's my broken hat, sorry.
We always tell people, like, stay in your lane. I know that sounds harsh, but it's
No,
true.
no.
Like, stay in your lane. You handle sales, but you know a little bit about finance. We stay in our lane. We handle finance, but we know a little bit about sales. So we feed off each other, right? We support each other. We can answer certain questions, but if there's something you're unaware of, you know what? Wes can answer that question for you. Just like I say, hey, Ulysses can answer that question for you. I think I have the answer, but I would rather have him.
And we've pivoted
And we've done that.
to perfection. We've done a lot of buyer consultations via Zoom, and we're crushing it. As a matter
After
of
you
fact,
do it for a while and you do a couple, it starts to just become natural. So he chimes in and then I'll kind of piggyback on it and vice versa. So, and I mentioned to Mo before, like, these conversations you have with your buyers, try to get us on the phone with them. Try to do a phone call at the minimum, a Zoom or even an in-person meeting. Anytime the three of us or whoever that is are meeting with your clients, it's gonna come over, it's gonna look a lot better. And I can tell you there are agents in here that will tell you, if you do that, the conversion rate of holding on to that buyer and closing a deal skyrockets. So there's some agents in here that do not do anything without meeting in person or over the phone or on Zoom. They will not hand off a name and a number. And even if the buyer's hesitant, they'll still push on it. And you do that a couple times, they're like, okay, let's do that. And it works. So.
and I'm going to hand you two of them today.
Yep, perfect. Why this matters. Buyers ask financing questions every day. What's the most common? How much can I afford? How much money do I need down? Because the most common misconception when it comes to down payment is you need 20%, right? Can you guys see that if you're taking a picture? I know it's...
Yeah.
Okay. What credit score do I need? Can I buy before I sell? Or should I buy before I sell? Or can the seller pay my closing costs? So very common questions that we get, and we want you to have some basic information in regards to this. The thing is you guys can have basic information and say, like, how much money do I need down? What would be your guys' response to that?
Have you ever purchased a house before?
Okay. What would be the next thing? What else? What kind of other question would you ask in a situation like that?
What do you mean?
Like when they say, like, how much am I going to need down? What would you say?
It depends. Most common, 10 to 20%.
Okay. Anything else? Any other suggestions?
Depending what type of loan.
Yeah.
Exactly.
Yeah.
What have you heard out there from
Yeah, what have
from
you
other
heard?
buyers, friends of yours?
I've heard that you need about 20% to put down, and your response can be, look, I can't tell you specifics to your situation, but what I can tell you is you can get in with as little as 3% down up to whatever you want. It just depends on your specific situation, but you know who can guide you and tell you the exact? My lender, Wes or Jesse, can get you on the phone, and we can get you on the phone with them and guide you. So an answer to that would be, like, as little as 3%. Now, whether you qualify for that, I don't know. But your question is, how much am I going to need for a down? It could be as little as 3%. Okay? So these are common questions that I think we get every day, and we want you guys to be able to combat some of this stuff, okay? So agent responsibilities. What's your guys' responsibility? Build relationships, find homes, negotiate contracts, manage expectations. Our responsibility, and that's why I'm saying we stay in our lane, right? Our responsibility is to analyze income, credit, verify assets, structure the financing, and obtain the loan approval. So that's the stuff we do. Those are the main characteristics. You guys handle the relationship. Well, we all handle the relationship, but this is the main focus for you guys. Once we've done our job, we now come back to you with the data that we've found out, and now we send you off to look at property, okay? Are we still involved in that process when you guys are out looking for property?
Absolutely.
100%. Why is that, would you say?
To keep them hot.
Well, keep them hot, yeah. I mean, it's hot out there right now, no matter what. They're gonna be hot.
Hot lead.
Payment scenarios?
Payment scenarios, number one. So one of the things that we both do when we are meeting with buyers is we are very focused on, listen, once Ulysses goes out there and starts showing you homes, if you see something that piques your interest and you're ready to write an offer, let us know. Ulysses or the buyer can text us an address. We will run payment scenarios immediately for
Which
them.
I
okay?
did on Saturday at
Which we've done.
9 p.m.
Yeah, we've done that. Why is that important?
You want to know what the payment is before you get an offer accepted so that you don't have to back out because now the numbers don't make sense.
Yeah, and I think it's important even more so now than it's been in the past is because a $600,000 home here in Corona, one in Fontana and one in Temecula are all gonna yield slightly different payments for two main reasons. Property taxes, depending on the age of the home and special assessments and Melrose, and
HOA.
homeowners insurance and HOAs. So I wanna run that number and say, hey, here's a great, I'm gonna actually show you, this is what I do, and it's on my phone, but I'll just show it to you. I just sent this to Josh. This is a cool little, so it looks just like this. It's got the property address, sales price, down payment, loan amount, what the rate is, the breakdown of the payment with the total, and then I put like a 2-1 buy down scenario on there. Just so they can see like, hey, if you wanna ask for a 2-1, this is what the payment would be on year 1, 2, 3. This is the cost of the buy down if we're gonna ask for seller concessions. And then I just reminded him, hey, the 1-0 buy down is still covered by us until June 30th. So it's just a quick text. I usually send that on a group chat to the agent and the buyer so they can see it. But I wanna make sure the payment still falls within that budget because every conversation we have in the very beginning with our buyers is not just about what they qualify for, but what kind of payment are they looking for? Because we need to custom tailor that. I did it actually yesterday. Mo was in here. I think you were the only one in here. I actually did a buyer consultation call in front of a bunch of agents just so they could hear. And it was really good for you guys to have an opportunity to hear what happens, what kind of questions they ask. But the main question is, look, I'll give you the answer on how much you qualify for, but that doesn't always correlate to a payment that people want. If I can qualify you for a $7,000 mortgage payment, that's awesome. But if you're only looking for $3,000, we need to figure out what purchasing power you have, and we can accomplish that payment, okay? The 4 pillars of loan approval is pretty straightforward. The main things we are looking at are income, credit, assets, and property, okay? So when we are pre-qualifying a buyer, are we just simply asking for them to fill out an application? No, we are not. We are asking them to provide documentation to us. The reason the documentation is so important for us lenders is that people put in income, they don't know what they're making. They put in net income, they put in hourly that's not accurate.
Yeah.
They put in their bonus that they got, but that really, I have to average overtime bonus and commission over 24 months. There's a lot of interesting structures and formulas that we use to determine income, even if they've owned a rental property for the last couple of years. It's not as simple as this is what my rent is and this is what my mortgage payment is. They think that's the simple calculation, and trust me, there's a much more complicated formula we have to use to go into determining income. So income is huge for us, and most people don't really realize how to do it. So they fill out their application. Guess what we do 95% of the time? We go in and we clean up that application to put in the right calculations, the right assets, the right material. Credit's also huge. I cannot, so here's the big thing about credit. Everybody is always asks us, do you have to run credit? Well, I don't have to run credit, but I'm not gonna be able to pre-approve you without it. Now, what we can do is we can do a soft credit pull, okay? Soft credit pull is great in the very beginning, but if you're interested in actually going out and looking at property and you're wanting to make offers in the future, we have to run a hard inquiry. Do you guys know why we have to do that? I cannot run automated underwriting like DU or LP without a hard inquiry. It does not read soft credit pulls. And what is one of the things that we put in a financing package? We put an approval letter,
DU.
a DU, and the proof of funds. If I don't have a DU in there, is it a super strong offer? Not really, not really. So we really wanna make sure we have a complete package to make ourselves look as strong as possible when we're submitting that offer. Any questions so far? Great. Assets. Assets are huge, you guys. If I see a bank statement that shows previous month had $400 in it and now it has $100,000 in it. Is that gonna raise a red flag?
Yep.
Absolutely. Our job is not just to look at the balance, our job is to look through. It kind of seems nosy, right? Like we're really looking at a lot of things. If we see deposits that are not characteristic of normal payroll, we're gonna ask about it, okay? My grandparents just gave me a $100,000 gift. Cool, I love that for you. I need a gift letter completed. I sold a car. Cool, do you have documentation to support that you sold the car? I need that. Everything is about sourcing where the money came from. And in a lot of cases, we just have to have a gift letter completed. Gifts used to be a much bigger hassle than they are now. We used to have to document where it came from, so on and so forth. Now, if somebody is gonna be getting a gift from a family member, I always tell them, don't transfer any money now.
Yeah.
Do not transfer funds. I'm glad that we know we have 100,000 available as a gift. Don't accept a check, don't let them wire the money, just hold on to it until the time is right. Once your offer is accepted and we know what escrow we're dealing with, I'm gonna have the donor that's gonna give that money wired directly from the donor's account to escrow. It will never touch the buyer's account. And why that's important is it just keeps a clean paper trail. All I need then is a gift letter signed by the borrower and the receipt from the escrow company saying they've received the money. Simple as that. The only thing we do have to look at is to make sure that wherever that money is coming from, if they put on the gift letter it's coming from Bank of America ending in 1234, the receipt from escrow needs to say Bank of America 1234. If it says Charles Schwab 8976, we're in trouble, okay? So we have to just document it and make sure that, and that's part of our coaching that we do with those clients, okay? Any questions on that? Property, I'll touch on really quickly. If you've got a unique property, maybe it's a fixer and you're not sure if it's gonna pass traditional financing, let us know, send us the property. We'll do a little bit of research. We're probably gonna ask you a ton of questions because there's certain, like if you've got an FHA buyer, it may not be FHA financeable, okay? So we wanna do some of the legwork on the property. We don't run into it a ton, but listen, you will run into that. You will run into some unique properties that need some work. We just had one the other day, I did an appraisal. I did not know her house was ripped apart. She's pulling equity out. She's got no kitchen right now. She had a leak. It's a problem. She needs the money for the repair, but I have a 442. She's got to repair that before I can actually close the loan. That's a problem. So we're running into a situation there. So if you've got a unique property, bring it to us. We'll let you know if it's financeable or not, okay? Any questions here?
Is that common with fixer uppers?
Pretty common, yeah. I mean, we have other loans like 203Ks, which are rehab loans. Renovation loans. We don't do a ton of them. To be honest with you, I don't ever hear about a ton of them, but they're out there. We have them. So you can actually finance, I mean, these days with the 203K, you can almost take it down to the studs these days. So, and you can actually finance the repairs into the loan. It's a very lengthy process, but it's available, so.
And what is the percentage for that?
It's a traditional, like FHA, is 3.5% down.
Oh, same? Oh, okay.
So what we typically do in those scenarios is when we send the appraiser out there to appraise it, he's going to appraise it, he or she will appraise it as after renovation value. So they're looking at like, okay, what are the plans and what is that home gonna be worth after this renovation is complete compared to other sales in the area, okay? So they're gonna give you an after renovation value because most of those are being picked up for 60, 70 cents on the dollar, right?
Right.
Because there's a lot of work that needs to be done,
Yeah.
okay? Great question.
So is it the same with the conventional loan also?
We do have conventional rehab, it's a little bit different, but yes, it's the same theory. Yeah, absolutely.
Okay.
The only reason you would really go with a conventional would be like maybe the size of the loan, because we have loan limits.
In
That's a
every
slide
county.
I didn't put on here, which I really should have put on.
In
here.
every
I
county,
didn't
yeah.
put it In every county, but we can talk about that. Is that Alicia?
That's Shavita.
Shavita, okay. All right, so did that answer your question? So we do have them for conventional as well.
Okay, thank you.
No problem. Income. These are the common things we're looking at. W-2 income, self-employed income, so tax returns from a business and personal. Retirement income, because we deal with tons of clients that are retired. So a lot of them are getting Social Security, pensions, right there, Social Security, commission income and bonus income. So there's a lot of different types of incomes we look at. I think we put over here, high income does not automatically mean qualified. I have people all the time that say, I make 150 grand, I should be good. Yeah.
But you report 200.
Yeah, you report 140,000 in deductions. I've got 10,000 showing on your tax return as adjusted income. Or just because they have a high income, they think they qualify, but they also have what?
A lot of debt.
High debt. It balances out. So High income is not always a game changer. It helps, but it's got to be the right fit. Okay. Credit. This is a big one, especially right now. We're looking at credit score, payment history, collections, bankruptcies, foreclosures. Can we deal with people that have had bankruptcies and foreclosures in the past?
Yes.
Absolutely. We've even got some programs, non-QM, so those really quirky loans, that will do like 1 day out of BK, 1 day out of foreclosure.
Short sale a day
Yep.
after.
Now, those are the type of loans where you're going to have to put a lot more skin in the game to get in. So you're probably going to have to put 30% down to do something like that. But the question is, that a lot of people ask is, do you have it? Yes, we do. Do we do a lot of them? No, but we have it, okay? A lot of the products that we have access to, we don't do. I know that sounds kind of, our main stuff is traditional, conventional, FHA, VA, USDA, some non-QM. Other than that, do I do a ton of reverse mortgages? Nope, but I got it. Do I do a ton of construction loans? Nope, but I have access to it. We've done them, we just don't do a lot of it, you know?
The demand is
So-
not there.
Yeah, the demand. And that's why I've said in the past, we have access to about 40, 45 wholesale banks. Every single one of those banks specializes in something. So when I've got a reverse mortgage, I know who I'm going to. If I've got construction, I know who I'm going to. If I got land, I know who I'm going to. And then when we're dealing with our more traditional agency products like Fannie, Freddie, FHA, VA, we've got 6 or 7 wholesale lenders that we can go to where we can really shop the rate, and they all have their unique nuances. There's one thing that I will tell you, and this is my personal opinion, I can't speak on behalf of Jesse or any other lender. There's 3 things in our business that as a lender we look for, okay? We look for the best rate, we look for speed, and we look for service, okay? The problem is you can't have all 3. Can't, period. You will not be successful. You can't have all 3. You can have 2 of them, okay? What 2 would you guys like to have, honestly?
Best rate. And
Service.
maybe?
Rate and fast,
Yeah. I like service and speed.
but then the
Okay?
rate will be higher.
Yeah, it could be, but we're talking a very minimal difference in rate. You know, we're talking it's not like we're talking a 0.5% difference. It might be an 1/8 difference, but the thing is if you want a quick escrow and you're trying to leverage speed and close in 17 days, I know what lender I'm going with because the other ones might need 30, right? So there are lenders out there that are really good at offering competitive, no, they're all competitive, but they're maybe usually a little bit better than but they're slower, right? So it's really important that if you're looking to leverage speed, which we do all the time, and that's gonna become a more common thing as this market heats up, you're gonna need to leverage that. So sometimes we're going to certain wholesale banks because of that particular reason, okay? So it's very rare you can find all 3. And honestly, right now, in all honesty, speed's not a problem right now. Nobody's slammed busy to where they're dragging their feet. You know, everybody is pretty decently moving at a pretty quick pace.
And
you
to
know?
piggyback to what Wes just said is that you want to make sure that you leverage business partners that can close in a reasonable time. Like I just received an offer on my Beaumont listing as a backup, and it was a 45-day escrow. And I called the listing agent. I said, "Why is your lender closing in 45 days? Why do they need an extra 3 weeks?" Well, my lender said that he can't do it faster. I said, "Then you need to switch lenders."
Yeah, that's
Because-
craziness.
And now Wes and I are writing offers. Guess what? 21 days.
Yeah.
Is that aggressive? Yeah. But that's why they're being evaluated.
Yeah.
So if your lender cannot close in 30 or less, then something's not.
In all honesty, 30 days seems like an eternity right now because we get stuff done so quickly that by day 15, we're done. And now we're just twiddling our thumbs, waiting for things to happen. To me, the longer the escrow, the more things can happen
Yeah.
that you don't want to happen.
Anything can
you
go
know?
wrong the longer it goes.
So, and I will say there are some changes. In fact, we've talked to Scott Oswald. If you guys aren't familiar with who Scott Oswald is, he's an agent here in the office, a very seasoned agent, been around, very successful. He's also an appraiser. And usually every year we have him come in and do a little bit of training. Well, come November 1st, there were some major appraisal changes taking place, huge changes. And what appraisers do when they walk into a home for 15 minutes, snap a few photos and take off, it's not gonna be like that anymore. They are literally gonna be having to measure every single room, every single bathroom, ceiling height. It is absurd, the laundry list of things they're gonna have to do. So we, a lot of times, will cut down our contingencies on our appraisal to 12, 14 days. And he says, honestly, based on what I'm seeing, it's gonna be hard to get these things done in 17 days. So we're probably gonna have him come in, probably, I think we said at the end of July, early August, just to talk about the changes. and then maybe the first of the year, which sounds far away, but by then we'll have 2 months of the new system, and he'll be able to be a little bit more specific on what is really happening and where they're seeing things slow down and how we can adjust it. Because I told him all the stuff he was saying, I'm like, do you have a template? Because you should have a template that you can give to agents to fill out to give you as much information, because he says, I feel like I'm gonna have to keep calling agents to get information over and over again. And this is gonna be the time when you don't wanna just send an appraiser to the house and say, hey, here's the lock. Show up.
Yeah,
As
be there.
new agents, you guys,
Be there.
show up to your appraisals. Don't be lazy and just send them to the house. Please don't do that. Like, be there, and I think it's gonna be even more important now.
Are you allowed to be there as a
100%.
buyer's agent?
Yeah, yeah. Oh, as a buyer's agent?
No,
Not really. You don't, honestly, a buyer and a buyer's agent really have no reason to be there.
Okay.
The listing agent who's representing that listing is the one that should show up.
Okay.
That's who the appraiser calls. That's who we give the number to.
contact info.
That's how they, you know.
Okay.
But a lot of listing agents get lazy and they're just like, yeah, there's a lockbox. Here's the code. Go check
It's
it out.
vacant.
It's vacant. Like, don't be that person. Okay. So that's just my.
And then they complain when the value comes low, and
Comes
then now,
low.
now you want to dispute it.
Yeah.
Too late.
Do your homework. Help them out. Provide them the comps you use to come up with your price. Doesn't mean they're going to use it, but it certainly isn't going to hurt, right? So, assets. I could go into crazy detail about assets. We look at everything. I think were we just talking about this?
Yeah.
We were just talking about this. Sorry, I thought I hit it. Sorry, geez. Property. We talked about property. You know, we talked about, like, if you've got some interesting things, HOA issues. If you're doing condos, you guys, condos is huge. If you're doing condos and we're doing FHA financing, and even VA, condos have to be FHA and VA approved. Okay? Trish had a situation this past weekend. You called me on a condo that was,
It's one of my mentees.
Yes.
So his buyers are buying one in Pico Rivera, or
LA.
they were. However, the HOA did not have at least 10% reserves available. So, because they were doing a grant, they were not allowed, the lender was not able to do the funding for that.
yeah,
So now they're in escrow with another condo and it has enough reserves.
reserves, yeah. So when we send a loan in to an investor to be underwritten, there are 3 actual underwriters on a file, okay? You always have your traditional underwriter that underwrites the loan. You have your appraisal underwriter, okay, that underwrites the collateral. And then if you're dealing with a condo, you have a condo team that has underwriters within it and I don't know what else you call them. It's a team. And they basically, yeah, like a pod, and they review everything regarding that condo. When you're dealing with government financing like FHA and VA, there are certain requirements that have to be met. Now, when you're dealing with big wholesale lenders like we use, they do so many loans nationwide that, believe it or not, they probably have a few loans in every single HOA complex out there. So they have data on HOAs already. So a lot of them have done the legwork. But we ran into issues like this back in 2008 when prices fell because what was happening? Foreclosure, short sale, people stopped paying their mortgage payments. And when you stop paying your mortgage payment, what do you stop paying?
HOA.
Your HOA dues. So if there's no dues coming in, the reserves are just being depleted, and now there's not enough money to take care of the upkeep
Of the properties.
So if they need new roofs in 10 years and there's not enough money to do it, it's a problem. Remember, the buyer is investing in this home. Who else is doing it too? We are, the lender, okay? The lender is usually investing the most. So we want to make sure that when you go to sell that home, you can. We want to make sure that property values go up. Because if they go down, who's going to lose when you come back to us to say, we need to qualify, we need to apply for a short sale? We don't want to be in that position, okay? So having an HOA be financially sound is huge. We do the legwork on that. If you're going to be representing a listing and you're taking a condo listing, do the legwork up front. And if you don't know what to do, come see us or your mentor and we will help you and coach you on what kind of documentation to get up front, okay? Any questions on that? Okay. The big 4 loan programs. We talk about these all the time, guys. God, this is really dark. You can't see it. So the most common, conventional financing. Fannie Mae, Freddie Mac, the 2 largest investors in home loans, they buy conventional loans. Now it says here down payment as little as 3%. Take notes of this. 3% is only for first-time home buyers. If they're a repeat buyer, it's 5%. It was always 5% for years. I can't remember what year they changed that. I would probably say that was like 7-8 years ago. They decided to be more competitive with FHA and offer something lower because it used to be 5% for
Yeah.
everybody. And then They're like, we need to compete with FHA. They offered the 3% down program. The caveat was you had to be a first-time home
And high
buyer.
FICOs, right?
And not necessarily, you can still do 620. So conventional, we'll talk about that on a different slide. But yeah, conventional requires slightly higher scores. So I'll talk more about that. FHA, great for first-time home buyers. It is not a first-time home buyer program, you guys. It is just utilized by a lot more first-time home buyers because of the 3.5% down payment, because of they're a little bit more lax on credit scores. So you don't have to have perfect credit to go FHA, okay?
Excuse me?
Yes.
Sir, what's the catch with FHA, or like the trade-off between that and a conventional loan? Is the interest rate higher?
Interest rate and mortgage insurance and what we call risk-based pricing. So I'm gonna talk about that in more detail and you'll understand it.
Okay.
VA, I'm a huge advocate for VA loans. You should talk to everybody. Are you a veteran? Nope, okay, cool. You know, ask everybody you know. It is the best loan we have in our industry. You just have to be active duty or a veteran to qualify, okay? And then you've got USDA. We don't see a lot of USDA out here, but there is plenty of USDA land. I shouldn't say, we don't do a lot of USDA loans, but there's a lot of USDA land out down the 215 heading towards Hemet. There's a lot of land out there that qualifies USDA. It's zeroed down. There's some quirky guidelines for it, but it's available, okay?
How can we find out that land?
There's actually a map. I'd have to send you the actual link for it, but there's a link you go to and you literally look at a map, and depending on where that house falls within the color of the map is if you qualify or not, okay? The thing about USDA is it sounds great because it's no money down, but you also can't have a ton of money. It is really for people that don't have a lot of
The
money.
resources,
So yeah, if you've got the resources to put down money, you're not gonna get the USDA loan.
So
Okay?
you can get that, and can you get like a construction loan on top of it?
Like stack it, I don't think we do USDA construction.
No?
That's a great question. I don't know the answer to that one. I don't know if I've been asked that question, but I can certainly check on that for you.
Sure.
Yeah, that's a good question. I don't know, but I'll look. So that's the 4 major loans. So here's conventional. So to your point, conventional is dealing with a little bit better credit. Primary residences, they do second homes and investment properties, okay? So 3% down as little as, or 5, with a 620 credit score. Here's the thing. Conventional loans, the way we look at interest rates and mortgage insurance. So if you're putting down less than 20% on a conventional loan, you're paying monthly mortgage insurance along with the principal and interest, the taxes, and your regular homeowner's insurance. The crazy thing about conventional loans is the minute you fall below a 760, which 760 is a great score, okay? If you're above a 760, you have reached the top bucket, if you will, the top tier for any more improvement to your FICO score. So whether you're a 760 or you're an 800, it is not going to change your rate for the better, okay? But if you go the other way, every 20 points, so now 759 to 740 is a bucket, 739 to 720 is a bucket. The lower those buckets go all the way down to a 620, the greater the impact is to the interest rate, okay? On mortgage insurance, it's the same thing. Your mortgage insurance, the formula we use is based on your credit score and, believe it or not, your debt ratio. So if you have a low FICO, 640, and you have a high ratio of like 45, depending on the price of the home, I've seen HOA or mortgage insurance at $500-600 a month. That's craziness, okay? So that's conventional, risk-based pricing. Now, if we go to FHA, I said it's first-time buyers because we see a lot of first-time buyers use it. Deals with low credit scores, higher debt ratios, 3.5% down. Now, here's the difference. If you're at 800, a 700, or a 660, you're gonna get the same rate. There's no risk-based pricing until you fall below a 660. With monthly mortgage insurance with an FHA, it does not matter what your credit score is. It is the same formula for every single homeowner, okay? So a lot of times it's cheaper. Plus, FHA rates tend to be a little bit cheaper right now than conventional, okay? My theory on going FHA versus conventional is if you're below a 680, it's really worth looking at both options. Because if you're below a 680, FHA is probably the better scenario based on rate and mortgage insurance. If we're trying to run a conventional under 680, a lot of times that payment is significantly higher. And it might be the difference between qualifying for the loan and not getting the loan. I'm a firm believer in the best loan in the world is, I want you guys to say it out loud, the one you can get, okay? They may want the conventional. They can't have it because they don't qualify for it, but I can get them the FHA, Okay, so a mentor of me told me that 26 years ago. I'll never forget it. I use it all the time. I hate saying it because it sounds harsh, but it's the truth, right? The best loan in the world is the one you can get.
Yeah.
Okay, so FHA is a great loan. Right now, interest rates on this are 5.8 to 6%, where conventional with a 5% down payment are probably 6.5 to, I don't know, today, it's even higher.
Yeah.
Today the market got a little nasty. So our new Fed chairman, Warsh, spoke today, didn't change rates, okay? We knew that wasn't gonna happen, but there was some new talk about possibly raising rates at the end of the year. And Wall Street and the market did not react well to that. Do I know if that's even gonna happen? We don't, but right now, it's just hearsay, right? Like, this could happen, and Wall Street is not liking it,
So now
so.
as realtors, can we control that? No.
No.
No, you can't control that. And honestly, it's not a bad idea to talk about it, because would you rather buy now with a lower rate,
Or wait till January?
or wait till January at a higher rate? You know what I mean? So this is the kind of information we look at and we use this. I will talk to somebody about that. As a matter of fact, I was in there, I walked out of the meeting and called one of my clients who hasn't locked, and I said, look, we need to talk about this right now because it is reacting, it's deteriorating quick. Let's discuss locking your rate, you know? So does that kind of answer your question about FHA conventional?
It does, yeah.
I know it's very basic, but
How
you know.
can we reuse the FHA?
How can you reuse FHA?
Great question.
Sorry, like eligible for FHA. You can use FHA for more than one time.
But not at a time.
Not at the same time, but yes, you can sell,
Not at the same time, yes.
correct, you can sell a house that has FHA financing and obtain FHA financing again. Remember,
And
the other
in how many
difference,
years?
no,
No way.
you can go from one house to the other.
I think your-
Can you
Your
explain
I
a
think your
little bit
question
more?
is how long does it have to be owner occupied?
What's the
I,
matter?
I think it might. have
Okay,
to
so
be-
you're saying
it has to
maybe
be-
not sell?
No. If we are living in one home, and for how long we have to be owner occupied? Yeah,
Oh, 2 years.
2 years. Yeah,
2 years.
Okay.
Yeah.
After 2 years, we can redo the FHA loan.
No. I guess that's two questions in one.
Yeah, it's
So-
2 questions in one, yeah.
So Shavita, you're saying how many years do I have to be there in order to potentially not be owner occupied and
Oh,
maybe
I
buy
see.
in something else with another loan? Or-
Yeah, I mean, if you lived in it for a year and you wanted to sell, that's not really a loan issue, that's more of a capital gain issue.
Correct.
So that doesn't really affect, you could live in it for a year and decide to sell, you might have some tax implications, but if you lived there for a year or less than 2 and you went and bought another home, could you use FHA again? The answer is yes,
Okay.
okay? The only loan that we have, so FHA is owner occupied only, that's why on conventional you saw second home investment. You cannot buy an FHA home as a second home or
Or with
an
a VA.
investment property. Or VA as well, VA requires. Now, the cool thing about FHA and VA that's really cool, you can buy 4 units with FHA and VA, 3.5% down or 0 down on a VA. That's huge.
Because you can live in one and rent the other.
Right, now if you've got all 4 units and they're actively rented right now, the unfortunate thing is you gotta boot one of them out because it's gotta be primary, right?
Right.
But that's okay, you're the new homeowner, you can potentially
Give them a
do that.
notice.
Yeah, okay, so FHA is a great product. We're using it all the time, you guys. It's a very common
What's
one.
the loan limit on FHA?
735. What is it, 762?
690.
760.
No, 690, geez, I'm like thinking, of yeah.
But it depends
Our
on the loan
limits are
limit of the
changing.
county, right?
It's county. He's gotta keep me on my toes, he's gotta keep me on my toes.
Riverside County. is
Yeah, Riverside County is 690.
And San Bernardino too, right?
San Bernardino too, 690.
I'm sorry, what's the limit for what?
For FHA loan,
FHA loan limit.
690.
Oh, it doesn't, the amount.
That's-
You
that's
cannot
the
finance
max.
more than that.
Yeah, that's the
Okay.
max, the max.
So
that
that's
you can borrow.
another thing that's sometimes challenging, especially here in Southern California.
Yeah.
Now, every year, those numbers go up a little bit, but 690 is workable. We're not running into a ton of situations, but it would be nicer if it was closer to 800, like a conventional.
We're having a
So-
situation in LA where
Yeah.
we wrote an offer, true story, Saturday, we wrote 2 offers for a client that we have. And it's an FHA client, 3.5% down, and the offer was 1.1.
1.1, yeah, yeah. So,
I was like,
but
what?
it's in LA County, it's a much higher limit, right?
Correct.
So you have different, and I should have put that slide on here for you because there are different limits for FHA, conventional, and VA for 1 unit, 2 unit, 3 unit, 4.
Yeah, that's what I was gonna say, how
Yeah.
you buy 3 units.
I
with
think on an
6
FHA on 1.4, on 4 units in like LA, I think it's like up to like upwards of like 1.4 million. you know.
Okay.
Yeah.
That's a shack.
It is in some cases, yeah.
A storage unit.
Yeah, it is in some cases.
By a parking lot.
Yeah, yeah.
And not a bigger one. Yeah, really.
Yeah. All right, so this is VA loans. Like I said, I'm super passionate about it. Zero down, competitive rates, flexible guidelines. I just closed, and this is a true story. I just closed a $2 million purchase in Norco. It was a $1.85 million loan, so they chose to put money down. 76 back-end debt ratio. VA does not care about ratios as long as the residual income meets the criteria. Like, so they had to have $1,394 in residual. That's what VA says for Southern California. You have to meet this residual. Residual income is like taking expenses out of their gross income, plus taxes, plus utilities. And whatever that number is, it has to meet residual. So if they're $1 below that $1,394 residual, they don't get the loan. If they're $1 above it, they get the loan. So you can see much higher ratios on VA loans. So, but it's not one of those things you should go out there and like, don't go out there and
Preach
promote
it.
that, preach that, because it's case by case. But I just closed one like literally last week, so it's pretty cool. So the other thing about VA, I want to touch on this real quick. The biggest hurdle for VA is agents aren't familiar with it, and they don't educate their sellers on it. It is the only loan we have out there where if the appraiser goes out there and the property value is going to come in low, they will call us and say, hey, Wes, Jesse, your appraisal is coming in low. They won't tell us how much, but they're like, we're enacting Tidewater, that's the term. They give you 48 hours to contact the agents, both buyer and listing, and get comps to support the contract price. And now, does it work all the time? Sometimes it does, sometimes it doesn't. But guess what? It's the only loan that gives you the opportunity to support your contract price versus FHA conventional, where here's the appraisal, guys, boom, take it or leave it. And once you try to do a rebuttal on a value that's done, I'm gonna tell you, in my 26 years, I can count on one hand how many rebuttals I've been successful
I've
with.
seen 2 in 21 years.
Yeah, it's appraisers don't like being told they did their job wrong. You know, that's the truth. So, but VA loans are great loans, you guys. Don't be scared of them. If you encounter a listing agent that's like, oh, I've had negative about VA, tell me why. And that's why we get so involved, because we contact the listing agent and we advocate for that VA, that veteran, okay? And we try to pump that deal up, okay? USDA loans, again, zero down, competitive rates, rural areas, again, that you can find by looking them up on the map. I can get you guys that link. It's a great program. You're not gonna do a ton of them, but again, guess what? We have it, okay? So, mortgage myths and facts. Now, you guys have all heard this before. You need 20% down to buy a home. Have you guys learned today? You don't need that? Zero down with USDA and VA. 3% down on a first-time buyer for conventional, 3.5% on FHA, and 5% down on conventional. And the best part is if they don't have that, what do we have in place? Down payment assistance for a lot of these people, okay? So down payment assistance, we have tons of programs. It doesn't mean that every buyer is gonna qualify for all of them. There's income limitations, credit score limitations. I showed you guys earlier, FHA goes to 580 credit score, right? I don't have a 580 first-time home buyer program. Most of them are 600, 620, 640, 660. So if you're a 590 FHA, but you need down payment assistance, guess what? We got some work to do. We gotta improve your credit a little bit so we can qualify for the first-time home buyer part of that, okay? So it has its own set of criteria that we have to meet. Any questions on that?
About that, what you said, how do you help them improve their score?
Great question. So, for example, right now, me and Ulysses have somebody, remember we talked about Vantage Score, FICO score? Her FICO score is a 529, her Vantage score is a 597. Theoretically, 597 meets the 580 minimum criteria. Well, we just learned that not only do we have to reduce the Vantage score by 20 points, because that's the requirement, we take that, whatever that score is, we drop it by 20 points. We were under the impression that was for pricing only. It's actually across the board. So when we run DU, the automated underwriting, is also reducing it by 20 points. And what does 597 turn into? 577, which means it doesn't meet the 580 minimum. Our borrower, when I called her to talk to her about this, goes, well, I just paid off 10 grand in credit cards. Oh, you did? Cool. I would have loved to have known about that. So what she's been doing over the last 2 days is providing me proof of all of her accounts showing a zero balance. What I do now is we order a rapid rescore. So what we're doing is, instead of waiting 30 days for these things to naturally hit the credit report, we're taking all the documentation, sending it to our credit pulling service. They have a backdoor channel into the bureaus to speed that up. We can't charge the clients because there's no guarantee of anything. We know it's gonna go up, but we can't charge for it, because what if it doesn't go up? We're on the hook. So it's the cost of doing business, and hopefully this 597 jumps to a 660, 680, just by paying off all this debt.
Yeah.
All I really needed to get to at minimum is 600, because 20 points would be a 580. And we're only 3 points away from that. And I can guarantee you what she's done is gonna raise it more than that. So there's a lot of things we can do. That's a question that we could go on all day about,
Right.
but there are some great things that we can coach people on. Yeah. Trish, you had a question on down payment maybe, or?
Yeah, okay, hang on.
Okay.
Okay, how long, yeah, I'm trying to think of that last question. Okay, so rapid rescore, how long do you have to wait before you can, request that? Is it 2 weeks? It's within 30 days, right? Or
No. So when we order the rapid rescore, it's the typical service level agreement is 2 to 3 business days. I've seen it take longer, but usually it's 2 to 3 days, but it could take 3 to 5, 7 to 9, depends on how many orders are coming in for rescores, but it's generally on average 2 to 3 business days, okay?
And then I just remembered my other question. So on the VA loans, I always ask you this and I always forget. On VA loans, when the buyer's asking for termite clearance, does the roof have to pass? I know that you said if you make the termite clearance one part of the contract, then the lenders are gonna see it, try and do that outside the contract, right?
On a VA, you can't.
Okay.
VA is the one loan where you cannot counter out termite.
Okay,
You have to have a termite report and you have to have section 1 items addressed.
okay,
It is the only, even on a VA refinance, I have to do it.
okay.
Which is kind of weird, kind of odd, but we have to do it on a VA refi. But if you're doing a conventional and an FHA, you do not have to have a termite. The only time a termite could come into play is if an appraiser goes out to a
Calls it out.
property and it is just so bad. Like, we used to see it a lot with like old wooden trellised like patio covers that are just like rotted out. They're like, hey, this is termite infested, dry rot road. If you didn't counter, or if you counted out termite, but the appraiser calls it out, guess what?
You're stuck.
You're stuck. Okay. Now, that is one of those things that doesn't happen very often, but it will happen at some point in your career. Okay. We see a lot less of that now, but yeah.
Do we still have 33 down payment assistance programs in California?
33?
I think you said, one time you said there's at least 33.
Oh, there's probably more than that, to be honest with you. Between
Really?
grants and down, yeah.
Okay,
Here's the truth. I focus on like 3 or 4 of them. And the reason for that is people will be like, oh, Riverside, the city of Riverside has one for $100,000. And then I was on a call one time because they were releasing one in a week. There were like 700 LOs on this Zoom call. And the amount of questions that were being asked on this were crazy. And finally, I asked a question. I was like waiting for it to like show up. I said, how much money do you guys have? And what was it was like,
Oh, ridiculous.
it was like $5 million. And I was like, that's a ton of money, right? $5 million. At 100,000 a pop, it's not that many people.
no, it's not.
You're getting 50 people.
20 loans for the entire state of California.
Yeah, like it's not that many people. So they're gonna run out of money in a hot second. So when you see these ones where it's like these big chunks of money, 50,000, 100,000, a lot of times they run out of money, or the criteria is absurd to qualify for, like the
dream for all.
the average median income
Yeah.
is so low that it's like, how can you even qualify for a house in Southern California? So a lot of them are just, I go with the ones that are just they've been around for, like Cal HFA, Cal HAFA, the ones that offer Dream as well. They've got some other great down payment assistance program, and they've been around since I've been in the business. They're not going anywhere.
But the buyer still has to participate, right? They still have to come in with some money. Because I think that's what happened to those buyers that we had last year.
So I have a real life example, and I'll just tell you right now, just to kind of, me and Scott Kafori just closed a transaction where the clients were first time buyers. They bought a home in Hemet for $400,000. They got down payment assistance.
Oh, yeah.
The interesting thing about a lot of these programs is we have to charge the borrower up front to participate in the program. So I've never been a big believer of this, but we have to charge 2 points up front to give them a 3.5% down payment assistance. Doesn't make a lot of sense. You give me 2, I'll give you 3.5 back. Okay? Why is it important that we get seller concession? Because now
To offset.
to offset that. Okay, so on our situation, the client had a $6,000 deposit. I got them a 3.5% down payment that they don't have to pay back until they sell or refi. There's no payment that has to be made on that second. It accrues simple interest at 1%, which is nothing, okay? We negotiated all of the closing costs to be paid by the seller, and guess what happened? They got their $6,000 EMD back at the close of escrow. They paid $0 except for
Wow.
their appraisal and their inspection to get in.
Wow.
That's huge. That was like $1,500.
Is it a house or a mobile
It
home?
was a house. It's in Hemet. It's a house.
Okay.
But still,
But still,
Still, that's a good.
it can be done,
Yeah.
you know, but we gotta negotiate, right? We gotta go into it knowing we gotta ask for all these concessions. So
Which down payment program?
that was CalHAFA, FHA,
Oh,
yeah, My Home down payment assistance. We can even get closing cost assistance. The rate goes up a little bit, but it's available too.
You can stack with Cal.
You can stack, yeah. Money needed to buy. These are common questions. So what are you gonna need money for? I need money for a down payment. I need money for closing costs, and I've got to come up with my earnest money deposit. As an agent, what are you telling people about? Inspection.
yeah.
We talked about the appraisal, which is something you guys can also mention as agents. You know, what are some of the things I'm gonna have to come up for in the beginning? Well, you gotta come up with your deposit, and that's negotiable. You can always ask for less, and they can counter you for more. But the two things that I can guarantee you're gonna have to pay are generally an inspection and an appraisal. Now, we do get waivers on occasion, but don't discuss that. That's not something you guys, because there's no guarantee of a waiver, okay? So these are really common questions we get. Who can help pay for these things? So I'm talking about this all the time, guys, seller credits. It's here now, and we're negotiating them. That VA loan that I just closed, I told you about with the 76 back-end debt ratio, I had $64,000 in seller concessions. 64, now it was a big home, but the problem was the buyer was selling a home in Ontario Ranch, 3 months, 4 months to get it sold. My seller of that big Norco property was moving to South Carolina. If she had put the home back on the market, what was gonna happen? She was probably gonna take 100, 200, maybe 250,000 less.
Yeah.
And we were having to drop the price in Ontario Ranch so low that they weren't gonna have enough for their closing costs and some of the other things, the paying off the debt that they had to take care of. So literally, they came in with their down payment and the seller covered everything else. She cut her losses. She stopped the bleeding. She gave away 64,000 versus potentially losing hundreds of thousands. Okay? But she still walked away with a ton of money. You know what I mean? But, you know, that happens sometimes. So down payment assistance, we have solutions for that. That's what we do. Gift funds are huge. Again, if you've got somebody that's talking about gift funds, the first thing you should do is say, great, don't accept any money, okay? Don't accept any money. Have whoever's gonna give that to you, just hold on to it. We know that we got it available. Now, if they've already gotten the money, we'll deal with that, okay? But in most cases, it's usually being talked about. My parents are gonna help us out, my grandparents, that's great. Tell them not to give you any money right now, okay? And then lender credits. We can help with lender credits. There's obviously certain things we can do. So that kind of comes into play as well, okay? Any questions on that?
Also check with Tigar because they had a $2,000 grant for
Oh, yeah.
first-time buyers
Yeah.
that were going towards closing costs.
Was that an income qualifying program? I don't think so.
No, it just had to be first-time buyers, and then they just had to submit like a letter on why they needed it, and it was going towards closing costs.
Yeah.
Now, those are grants that our local association has. But once the money's gone, it's gone. But then the following calendar year, they'll get some different grants, but they will cover certain costs, like they'll reimburse some buyers for their home inspection or for their home warranty. This year, they were doing $2,000 towards closing costs, which is big.
Yeah.
Yeah.
Yeah, you guys just ask around. Ask. There's a ton of stuff out there. You just gotta ask. Yeah.
The Tigar.
Yeah.
That's the Association of Realtors.
Association, yeah.
they just have to be-
This one's a big one because this actually shows up on your guys' RPA.
Yeah.
You're gonna check, is this a pre-qualification letter or is this a pre-approval? What do we want you guys to check always?
Approved,
At
underwritten.
minimum, pre-approval. In some cases, we even have conditional underwriter approval, which we can talk about more in the future, but the most common thing you're gonna see all the time is a pre-approval. Why? Because a pre-approval, we've verified credit, income, and assets. Here on a pre-qual, it's like a phone call. We ask a couple nosy questions, they give us some wrong answers, and we base our answers on those wrong answers, right? So remember, people don't know their income. They lie about how much money they have.
Always.
They always tell us they have a higher score than they do. Everybody I talk to is like, my score's in the 800s. No, it's not. I already know it's not. But people do. And yes, there are people in the 800s, but oh, my score is in the 800s. Okay, we'll see. So we kind of we kind of surpass this and just go straight to pre-approval.
Yeah.
Okay, don't waste time. Okay, so if you've talked to somebody that's like, I've been pre-approved, all you have to do is say, cool, you took an application with your lender and provided all your documentation. Oh no, I didn't give them anything. This is what they did right here. Okay. The loan process, the 9 steps, you guys are pretty familiar. Pre-approval, we get them approved. You guys go out house hunting, we get their offer accepted. You guys do your inspection, we order the appraisal, we get conditional from the loan, from the underwriter. Eventually we fulfill all the conditions, we sign and we fund. That's a really quick 9-step process, but that's really how it is, okay? So there's a lot that happens in between all of these stages.
Oh, yeah.
I have said on many occasions, our business is a problem-solving business. Some problems, you can't even see the little blip. Some problems, you see the big blip, and you got to work through it, okay? Jesse has the big blips all the time. But no, it's all about communication and working through things. If you get into a situation where you've got a smaller big blip, do we address it immediately?
Yes.
100%. Let's address it, figure it out, because the sooner we know about it, the more time we have to fix it. And trust me, you will run into situations like that, okay? Loan red flags, this is super common, and we talk about this. You guys should talk about this in your post, in your pre-call, in your first call, your discovery call. Don't go buy a car. Don't open up new credit cards. Don't change jobs. Don't make any large deposits, and don't miss payments, okay? These are pretty self-explanatory items, but I can tell you how many times it's happened to me where people have bought furniture for a home they don't own, a washer and dryer. I want the new car to put in my fancy new epoxy floored garage. It happens, okay? There are certain things that I tell people, look, if you absolutely need to do something here, come to me first. I've had people that said, I got a job opportunity. Can I change jobs? Yeah, actually you can, but here's what we need, okay? It's not just don't change the job and don't tell me. I've had people that change jobs in the middle. Who am I to say, don't take an extra $30,000 a year? Like, I can't tell you that. I can discuss the scenario with you and determine what we need to do, but there are definitely steps that can be done. I've done loans all the time where people have changed jobs in the middle. It's a matter of knowing about it and working through that scenario, okay? Large deposits, we work around that. Opening credit cards, one thing I always tell people is opening credit cards is one thing. If you're paying off debt, don't close credit cards, okay? Because lengthy seasoned credit cards give you a lot of history to your credit score. If you pay something off, don't close it. What's happening right now, believe it or not, is if you've had a maxed out credit card for an extended period of time and you've just been making minimum payments, what's happening now is the creditors are closing cards on people because they're taking that opportunity to say, we're gonna limit our exposure with this client. They've been sitting maxed out for 3 or 4 years. We feel like we're never gonna get paid off. We don't want that to happen again. We got our money, let's close it. You can't control that. They don't even call the borrower and tell them. They just close it. That happens. I don't know how to fix that. It's just one of those things with the creditors we're seeing right now. So, any questions on any of this stuff? Okay. Top buyer questions. I think we talked about this earlier. How much can I afford? What score do I need? We already kind of hit that up. This was the one I was talking about in Hemet, the first time home buyer real world success, 3.5% down payment assistance. Seller paid 100% of the closing costs. Deposit refunded to the buyer. Look at that number, guys, 0. And really it wasn't 0, it was their inspection, but really no down payment, no closing costs. Most of their money back. That's huge. Does it happen every day? No, but we do see it, okay? Financing cheat sheet, you guys already have that. It says take a picture. If you guys didn't, that's just kind of your down payment. Final takeaways today. So one thing I would encourage you guys to do, ask lots of questions, okay? But also listen. What did Raquel say in her training yesterday? What was that thing
What are you
she,
talking about today?
what is it called?
Wait.
Wait, why am I talking?
Why am I?
Yeah, like, here's the, oh, it's right here. Here's the thing. Ask the questions and then wait and see what they say. If you're constantly talking and you're not giving them an opportunity to speak, that's a problem, okay? So ask lots of questions. Doing that's gonna do what? It's gonna create confidence. The more you guys talk about the general stuff regarding financing, or if somebody asks you, the more confident you're gonna become. Again, I don't want you to become experts at home loans. That's not what we're doing today. We're giving you the basic knowledge so you have a general idea so you can carry a conversation with a buyer that asks simple questions. If you don't know the answer, don't try to give the answer. See, I've got the perfect person that can answer that for you. Why don't you call my lender Jesse? Why don't you call my lender Wes? We'll help you. They'll help you do that. Okay?
Yeah, I do that all the time. Hey,
You
that's
do?
a great lender
Yeah.
question. You know what? Let me get my business partner, Wes,
Yeah.
involved.
Yeah, you guys, we are business partners. That's exactly how you should. Let me get my business partner Wes on the phone. He handles the financing. Like that's how we should be presenting ourselves as what? A cohesive
partners,
team.
yeah, team.
Partnership. Identify opportunities. When you're asking these questions, you're identifying the opportunities. If you know the home that you're doing an open house in, the average payment's $5,000 a month, and somebody comes in and says, "I'm really looking for a payment of $2,500." I'm going to give you guys a little cheat sheet that kind of gives you a range. It's not to go off of completely, but this is the price range probably where you need to be with $2,500 down, you know? So you'll have something to kind of go off of. And then connect buyers with solutions. What's the solution? Getting them in touch with a lender. I have said this over and over again. I said it in a training class tonight to a bunch of people looking training for their license, is regardless if somebody says they're waiting a year or 2 or 3, we should be meeting with all these and doing buyer consultations regardless. Because I would say 30-40% of the buyers that want to wait a year or 2 that really don't even know why they want to wait a year or 2 end up buying sooner because they didn't realize and they self-diagnose the fact that they can't buy.
And a lot of times a client is going to say, you know what, Desiree, I'll be ready in 6 months.
Always.
Don't call them in 6, call them in 2. Because somebody more experienced will reach out to them in 2, and they'll get the listing, they'll get the listing and the sale, and you'll call them in month 6, and they already made a decision.
I asked a gentleman last night. He said it's going to be about 6 to 9 months, and I said, okay, that makes sense. I totally get that. I said, but what's that? Well, we've got our lease, and I said, well, you should talk to your leasing company because a lot of times they'll let you out if they can release the property.
They'll rent it quicker
They'll rent it
anyways.
quicker and confirm. I don't know if I'm pretty sure that's accurate. It's a state law where they can't collect a previous lease and a new lease, right? They can't double up. They can't double up.
No, and the home or the landlord or housing provider can't sit on his hands and not
Right.
try and market.
I haven't heard of a buyer breaking a lease and getting stuck for the lease in a long time. Like I can't even remember the last time. So a lot of them can get out of it. But I asked him straight up. So if we get you approved today and we can find what you're looking for in your price range, would it make sense for you to move forward now? And he was like, yeah. I mean, like put him on the spot, but in a nice way. What are they going to do? Say, nah, I don't think so. They're probably going to be like, yeah, I guess we probably could do it, you know? So it's just about creating conversation. The more conversation you have, the more information you're going to have, the more opportunities you're going to create. Okay? So I think that's it. Any questions? Final takeaways? Trish, let's start with you.
So, I had a question, and I think it goes back to, my client psychology. When, a buyer has filed BK, how long do they have to wait before they can qualify for a loan?
Okay, bankruptcy is discharge date, so there's different bankruptcies, okay? There's 7, there's 11, there's 13,
Yeah.
12, there's a couple different. The most common is Chapter 7, okay? 2 years from the discharge date, okay? On a Chapter 13, where they're paying the debts back at a reduced price, but they're actually paying it back, that period, I think, drops to a year after the payoff is complete. Or I think actually I think on an FHA, we can take into consideration the payments they're paying, but we have to get a court order on that because it's not theoretically discharged. So we got to get a court order on that. We run into 7s more than we do 13s, okay? But it's not unheard of to see that because we have a client that just got done with a 13.
What about short sales?
Short sales is going to be just like a foreclosure. Yeah. Now there are extenuating circumstances for things. Extenuating circumstances is a category where you had a death, a divorce. My job transferred me from here to the. There are certain extenuating circumstances that have to be well documented to not be classified as a serious derogatory situation like a foreclosure or short sale or even a BK. Well, not really BK, foreclosure, short sale, but you got to document it very well. So
Because I remember back in the day when we were doing a lot of short sales back in 08, I was helping families a day after the short sale was closed to buy with an FHA loan, as long as the short sale was forgiven in writing, like the balance was forgiven.
yeah.
And I was able to negotiate the balance so
Yeah.
that they didn't have to repay it.
Yeah.
And a day after we closed and funded and recorded, we can
Yeah.
start buying again
Yeah.
with an FHA loan.
The market, the mortgage industry kind of conformed to what was happening after 2008 and the repercussions of that, and then it slowly kind of went back to its old form because we really had to just generate homeowners again, right? And not having people buy was a bad situation, and some people couldn't buy for 7 years depending on the situation. So Yeah, 2 years, 4 years conventional. If it's a foreclosure, it's even longer. So, but 2 years, I mean, 2 years is nothing, you guys. Go rent for 2 years, and now you can, and I don't even ask about the BK. If it's a Chapter 7, I'm like, I don't care. The thing is, what I will tell you is don't be late again on something. Because you've gotten your one free
Pass.
get out of jail card, right? Your pass. If you go
Don't make
back
it
to
happen.
making late payments again or getting collections, like that's a really bad situation.
Don't make it
If we
happen.
see that, that's a problem. Okay.
We do have that new investor that allows us to lend on people who got filed for bankruptcy like the next day.
Yeah, we have that. We do have that. But again, it's not going to be traditional FHA. You're going to have to put some skin in the game. So remember, when you start dealing with alternative ways of qualifying, like non-QM loans for self-employed borrowers, when we're not using traditional pay stubs, W-2s, tax returns to qualify, and we're looking at niche way, can't even say it, niche ways of qualifying, these alternative ways come with risk, right? Because we're not verifying income. So what comes with risk? Higher rates, more down payment. Okay, so you're always, if you're gonna start getting into a situation where you've got a 1 day out of BK or foreclosure, are you gonna need more down payment? Yeah. Are you gonna have a higher interest rate? Yeah. Guess what? The best loan in the world is the one you can get.
I think this one's 3.5 down.
Is it really?
Yeah.
It's not FHA though.
It follows FHA guidelines. So.
Okay.
Yeah.
Is FHA insuring it?
If I don't, that's a good question.
Let's double check that. Let's look into that.
That's a crazy loan. If you can
That's
do
what I was
it.
gonna say. That's crazy. But again, to Jesse's point, like things are happening all the time. So
There's options.
There are options. Yeah. Mo, you had a question?
So the first slide, common questions, one of them was, can I buy before I sell? And I don't know if you answered that already.
No. So so let's say somebody has a home already.
Right.
Okay. Most people can't qualify for 2 mortgages. Not saying all, but it's a pretty hefty thing to do. Qualify for 2 mortgages. So if you are looking to sell that home, in a lot of cases, we can get creative and show it as a rental property, sometimes, okay? More often than not, what we really want to do is sell that home first. But if that home is taking an extended period of time to sell, because marketability is 60, 90 days, and their dream house just came on the market, we have solutions for that. Like we have bridge loans,
Okay.
where a bridge loan will allow us to pull out a lot of equity on the home that is listed, which at that point it can be listed, it has to be listed. I can pull out a certain amount of equity, and I don't even care about the payment on that home anymore. The lender is like, cool, we'll give you the money, you better keep your home listed, you got a year to sell it, but we'll give you the new house, and you can qualify with the 1 loan, okay? I will tell you, bridge loans are not the cheapest, but guess what? It's an option, okay? We've done them. So bridge loans are great, but those are situations